Good afternoon. Thank you for joining us on today's ESA webinar, Unpacking the latest round of COVID funding, its impact to the electronic security and life safety industry. The latest coronavirus funding relief included a provision that expands deductible expenses and revives the PPP with a fresh round of funding. This development also overrides previous guidance from the IRS and Treasury last year, which said PPP loan forgiveness could not be deducted. So what else is in the new funding package, and how do these developments impact businesses like yours? In this webinar presented by ESA's Executive Management Professionals Group, industry financial expert Mitch Reitman will walk through these developments with an opportunity to get all of your questions answered in a collaborative open Q&A session. I'm Jillian Bateman, ESA's Chief Development Officer, and I'll be facilitating our discussion today. Before we dive in with our expert, I do have a few tips for those of you joining us on your first ESA webinar. Welcome. ESA, or the Electronic Security Association, is the largest and longest association serving the pro-installed electronic security and life safety industry. Our members are integrators, dealers, monitoring centers, and even manufacturers and service providers in the space. We are the voice of electronic security and life safety. If your company is a member of the association, thank you. We hope you're taking advantage of the ESA benefits available to you to leverage growth and connections for your team. If your company is not yet an ESA member, check us out. You'd be surprised at the power of membership. You can get a feel for all the ESA benefits, including savings on business insurance, training, sales team coaching, and certifications that satisfy state licensing at esaweb.org. Okay, now we can get into the good stuff. First, all callers will be muted for the duration of the webinar, but that doesn't mean we don't want to hear from you. If at any point you have a question or a comment about the content that's being reviewed today, click on the Q&A button at the bottom of your control panel, and I'll pose all of your questions to our speaker. There's no need to save the questions until the end of today's presentation. If something pops up, go ahead and ask, and we'll ensure we have time at the end of the session to address your questions. We'll also be recording today's webinar, so you can watch the on-demand video at your leisure and share it with your colleagues. Give us until tomorrow to get the video exported and hosted on the ESA site. You'll receive an email with a link to the recording. We at ESA realize your time is valuable, and we appreciate you spending some of that time with us today. As I mentioned, this session is the brainchild of our Executive Management Professionals Group. We opened it up for the industry at large, but these types of topics are addressed with the EMP group confidentially all the time. For those of you unaware of ESA's EMP group, this is a community of ESA members who get together in small group format every month and have conference calls to talk open and freely about issues. Social capital is the most valuable currency in business. This group links you with other ESA members in similar executive management roles, so you can bounce ideas off of each other and collaborate in a confidential environment. It's lonely at the top, but it doesn't have to be. The group talks about issues like sales commissions, mergers and acquisitions, business model development, and more. If you're an ESA member and you're interested in joining this group available to you, head over to esaweb.org/EMP to fill out an enrollment form. I am going to pop up a quick question for you all on your screen. If you would like an Executive Management Professional Group member to reach out with more information about the group, a fellow security pro, you can go ahead and answer it here, and we'll make sure they reach out to you. Thank you, everyone. Before we welcome Mitch, I do want to also thank our ESA Diamond partner, Residio. It is through their support of ESA that we're able to produce content like this to help elevate the Pro Installed channel. Thank you, Residio. Without further ado, I'd like to introduce our expert today, Mitch Reitman. Mitch is the founder and managing principal of Reitman Consulting Group, where he provides tax compliance, due diligence, brokerage, valuation services, litigation support, and financial consulting to the systems integration, security, and fire alarm industry. Mitch, let's dive in.
Thank you, Jillian. Glad to be here today, and hopefully we're coming toward the end of this terrible catastrophe we've been experiencing for about a year. And as most people know, they've attended my webinars before. This isn't a sales presentation. This is general information I think that you should know. If you have an advisor you can get more information from, you should call them. If not, any ESA member, if you want to send me an email at any time, my email address is right here on the slide. If it's a fairly easy question to answer, I'll just answer it for you, and you'll never see a bill or have to worry about it, because I want you to survive and take advantage of all this stuff. So this is talking about new funding and new sources, but what's happening in Congress now that the election's over and things are getting back going is there's more than just funding. There's tax credits, there's tax deductions, there's extensions of some provisions, and some other things that have come about. And so I want to talk about the whole package, not just the latest round of relief, and kind of let you know what's still out there, what is being extended, and what is now coming on the horizon. So going back to a brief history, it's really funny. I was sitting the other day thinking about a year ago, we were just starting to hear about COVID. I was on a flight to California and a couple people were wearing a mask, and we all thought this is going to be something that would be gone by the summertime. We weren't too worried. And in the spring of 2020, the government sat down and tried to figure out a way to get us through this and deal with some of it. And the thought then was it wasn't going to be a long-term catastrophic economic consequence, and that the few government agencies, the IRS and the SBA and FEMA, could take care of it all. Well, as we all know, that didn't quite happen. It's a little more than that. But in April of last year, late March or April of last year, the Congress passed the Families First Coronavirus Response Act. Then they passed the CARES Act. Then they passed the Payroll Protection Program. And then President Trump later on issued the Memorandum on Employee Tax Deferral. So I want to talk a little bit about these things. They're actually still out there and they've been extended. And a lot of companies are very confused about them, and mainly because they were rushed through and they're not well thought out. But the first is the Family First Coronavirus Response Act is still out there. And just the particulars of it at a high level is, if you have an employee that's a virus victim and is directly affected, you have to give them 80 hours of paid sick leave at their regular rate. If they're a caregiver that has to care for somebody that has coronavirus, you have to give them 80 hours of pay at 2/3 their rate. And if they're parents of kids that are out of school or daycare, you have to give them 10 weeks of pay at 2/3 their rate with a cap of $200. So that affected a lot of central stations, a lot of alarm companies, but that's still out there. And the way that they're funding this is by tax credits for your payroll costs. And the IRS has never been really clear about this and how you're supposed to go about doing it. The 941, which is your quarterly payroll tax return instructions, went from one page, just do a couple multiplications and a calculation and send it in, to 52 pages, and now over 100 pages of instructions how to compute this stuff. It's very complicated, but very beneficial. If you've had an employee that's been subject to any of this, very important, one, to understand how to do the form and how to get the credit. And so if you're not getting the right advice, call your tax pro and make sure you understand it. But two, to make sure you're documenting this. If you do have an employee that's subject to this and is out for corona or out because they tested positive or is out because they're caring for a child, get the documentation now, because what you don't want to be doing is sitting 2 or 3 years down the road from now across the table from an IRS auditor and not being able to prove that you actually paid this money out related to COVID. The next thing that came around was the economic disaster EIDL loans. And historically, EIDL loans, these are the traditional disaster loans from the SBA. They were for victims of natural disasters, an earthquake, a hurricane, something that's combined to a small geography. And so it was easy for the SBA to administer them and easy to get them taken care of. And they usually contain a grant where if you had a hurricane and the windows of your business were broken, you could get a quick grant to get the floors mopped and things cleaned up and windows covered over. They tried to use this for the entire nation and call the entire United States a disaster area. And it was very clunky. It didn't go very well at the beginning. They capped the grants at $10,000 or $1,000 per employee, up to $10,000. But one thing a lot of people didn't understand is these are not PPP loans that get forgiven. These are loans from the SBA that, yes, they carry a really long repayment term, and yes, they have a really low interest rate, but they do have to be paid back. And they have some really restrictive terms, because if you have an EDL loan or you're going to get an EIDL loan, what you're saying is my business has suffered a catastrophic event, and without this loan, we can't survive. And so where we're running into some issues that people didn't understand is a lot of owners of S corporations and LLCs are used to taking a lot of their compensation as pass-through earnings, net income of the company, and taking distributions. You cannot do this under the terms of an EIDL loan. So if you want to do it, you have to get approval from the SBA, but good luck with that. But be very careful to read through the terms of your loan agreement. It's going to put a lot of constraints on what you can do with your business and what you can do as far as debt. So EIDL loans are not just a handout. The other thing that's caused a lot of confusion, this is done by executive order, was the employee FICA tax deferral. And it applies only to the FICA that you take out of the employee's paycheck to satisfy their part of the FICA each pay period. That was available up until December 31st. And originally it had to be paid back by the employee by April. They've extended this now for the entire year, so it won't be quite as big a bite out of the employee's paycheck. There was some talk that they were going to just forgive it all, but I don't see that happening. The biggest issue you need to be aware of is if you've done this and you've not withheld money from the employee's paychecks through 2020, and the employee leaves or the employee doesn't pay it back, you as an employer are on the hook for this. So be aware of that and be very careful to make sure if an employee leaves or you've done this, you get that FICA paid back before you let them go. Next thing is what is all over the news right now and everybody's excited about is the PPP round 2, which is the second round Payroll Protection Program loans. Now, remember when the first round of PPP loans came out last spring, it was thought the coronavirus would be over by the summertime. And so if they could just get employers through a few months of payroll, that everything would be okay. And one thing that the press has mischaracterized and a lot of people have misunderstood is these were really not intended to help businesses. These were intended to keep employees off of the unemployment rolls and to keep the unemployment offices from being overrun by people going to file for unemployment claims. So the idea behind the first round of PPP was just to kick the can down the curb for 60 days and hopefully everything will be okay. Well, here we are 9 months later, everything's not okay. And so they come out with a new round of PPP loans and they're very reticent of how they were abused last time. And so they put some things into the program to make sure that in their opinions, these things don't happen again. What is really interesting is that last spring, they made it for the loan amount for 2.5 months of payroll, thinking that in a couple months, everything would be over. They made the program this way the second time, which doesn't really compensate people for the time that from June when these PPP funds ran out from the first program until now, when you're going to get them again, but at least it gives you some compensation for having paid these employees. So what are the new limits? You can't have more than 300 employees unless you're in an NAICS code beginning with 72, which is a restaurant or a hotel. And the big thing that's keeping a lot of people out of this program is you have to have a revenue reduction of 25% or greater in 2020 relative to 2029. So for 1 quarter of 2020, your revenues have to be down more than 25% over what they were in 2019. Now, this is something that is keeping a lot of people out of the program this time, because what they're trying to do and what they're succeeding at doing is saying, look, you have to have suffered. We're not just going to hand money out to you, because obviously a lot of the companies that hadn't suffered hit the press, and it was fairly embarrassing. But on the other side of the coin, this is meant to keep people off the unemployment roll. So even if your company was doing well, the fact that you were able to keep up your payroll for employees that weren't very busy helped the unemployment offices. So the problem is that this is in there. It's probably going to screen out about 80% of the companies that availed themselves of the PPP-1 loans, and be very careful about manipulating or moving anything around between quarters in 2020, because even though there are a lot of loans and a lot going on, the SBA is staffed up tremendously, and they staffed up a lot of enforcement people. And if they catch you manipulating numbers to get one of these loans, when they do the review a year or so down the road, you could be in a lot of trouble. Now, to get the second draw, you have to have used the first draw for the full amount on or before the date when the second draw is dispersed. So if you haven't used all the money, which I'm having a hard time finding anybody that hasn't, you can't get the second loan until you do. So one other thing that has hit the news that hopefully most people understand, when the original PPP loan, the first round was passed, there was an item in the bill that Congress put in the bill that said that the proceeds for the loan would not be taxable. Typically, if somebody forgives a loan, you get taxed on the forgiveness of the loan. But the bill specifically said if you got a $100,000 loan and was forgiven, that would be tax-free income. You wouldn't pay tax on it. But the IRS took a really hard stance, even though it didn't say anything about this in the bill, that the underlying expenses you paid for with the loan would be taxed. So in essence, you're getting a $100,000 loan that's getting forgiven. You spend it, say, on payroll and rent, the $100,000. The IRS took the position that it wouldn't be forgiven. So several trade associations, one of which I belong to, the AICPA, which is kind of the ESA of the accounting industry, lobbied Congress heavily, lobbied the IRS heavily. And so when they passed the second round of PPP provisions, they specifically said that the deductions for these otherwise deductible expenses will be deductible. And so there won't be any tax effect. So that helped a lot of my clients with their year-end tax planning. They're not going to have to pay tax on the expenses they pay with these loans. So be aware of that if you hadn't heard already. There's a lot of talk right now about the additional stimulus payments that are going out, the $600. And really what they are is not a stimulus payment. The act that was passed in late December provides for a $600 credit on your income tax that's refundable. Refundable means even if you don't owe any taxes, you get it back per member of your household. $1,200 for married filing jointly, and $600 per qualifying child, as long as you meet the requirements. This really isn't a stimulus payment. It's an advanced payment of a tax credit that you'll be able to take on your 2021 taxes. So be aware of that. If you didn't qualify for this and they sent you the check anyway, you're not going to be able to take the tax credit on your tax return, and most of the software will pick that up. And so even if you got the $600 check and thought it was a mistake and cashed it, you're going to be on the hook for it at the end of the year. So it's really not a stimulus payment, it's a tax credit. And some things at the end of December bill made permanent were they had temporarily expanded the medical expense deduction floor. That means if you itemize expenses and you had medical expenses, it used to be over 7.5% of your adjusted gross income. So if your adjusted gross income is $100,000 and you had more than $7,500 worth of medical expenses that weren't reimbursed by insurance, you could deduct them. Or now you can deduct them up to 7.5%. It used to be 10%. So now if you had that scenario where you paid, let's say $9,000 of medical expenses, you could deduct the amount over $7,500 where it used to be $10,000. So for people caring with anybody with COVID, for people caring for an elderly relative, for people with catastrophic medical bills that itemize, this could be a big change. One thing that really doesn't matter much, but I need to bring it up, is they've made permanent the deduction for any energy efficient commercial buildings. Now, some of my clients do this. They build an energy efficient commercial building and get a huge tax credit. So if you're thinking of building a new building, talk to your tax pro about that. They've extended for 5 years the employee credit for paid family medical leave. It's different than the payroll tax credits for COVID leave. But if you think you're subject to that, the good news has been extended through 2025. There are a couple of small credits that residential energy credit and energy investment tax credit for solar energy. I'm seeing a lot of my clients in a lot of states start making investments in solar panels and stuff like that. They've extended those tax credits for another 2 years. And then some that are insignificant, but some that are significant. There's some 1-year extensions, 10% credit for qualified non-business energy property, credit for qualified fuel cell motor vehicles, and a 10% credit for plug-in electric motorcycles or two-wheel vehicles, and health insurance coverage tax credit. It also extends the payroll tax credits for the stuff we talked about at the very beginning, the Family First Coronavirus Act, through the end of March of 2021. Originally, they expired at the end of 2020. So now if you do have an employee that's out with coronavirus, you can still take that credit. The employee retention tax credit, that is a tax credit that if your revenues are down by 50%, but you still pay an employee and you don't use PPP funds to pay for it, you can still take a credit and try to recover some of that money. This is a very complicated credit. And so if you want to take it, talk to your tax advisor before you do it. One thing that the press has gotten completely wrong that I think for my clients is a huge provision in this new bill is the temporary allowance of full deduction for business meals. Now, the press has said that this is going to bring back the 3 martini meal. For my typical client, they may have an installation going on 120 miles away from their office where they've got 5 or 6 employees living in a La Quinta hotel and eating breakfast, lunch, and dinner at Denny's. And under the 2017 Tax Act, those meal deductions went from being 100% deductible down to 50% deductible. What this is saying is that if you have food or beverage in a restaurant, it's now 100% deductible and not 50% deductible. It has to be a business meal. And one of the provisions is if it's not something like you're out of town and traveling, if you're meeting with a client or something like that, you have to be talking business. But one thing to be very careful about is this isn't going to be allowed for entertainment expenses like entertaining 100 people at the ISC show, where you rent a room for $10,000 and serve pizza and egg rolls and stuff like that. This is for an actual meal in a restaurant. There's also quite a bit of concern about whether this is going to cover. It definitely doesn't cover going to a ball game and eating hot dogs. Whether or not it covers having a seat in a skybox and eating there, because there's some questions as to whether a skybox is a restaurant. But this is big, and I know a lot of my clients lose $5,000 or $6,000 a year in lost meal expenses and meal expense deductions. One thing to remember on the PPP loans, the second round, is that when you're applying for the loan, it's not just the amount of your payroll that you've actually paid out to your employees, it's payroll and payroll related expenses. We've seen a few where we've been able to catch it before the application went out, but if the application goes out, you're pretty much screwed. Payroll related expenses include any kind of expense related to employee compensation on a state level. So if you're paying for their insurance, to the extent you're paying for it and it's not being deducted from their paychecks, that is includable in your PPP-2 loan. So you can take 2.5 months of that. If you're contributing to a retirement plan or making a 401k match, the amount that you're contributing, not the amount you're taking out of their check, that is includable in the amount of the PPP loan. State unemployment is includable. Any kind of state payment is includable. What is not includable is any kind of federal tax, including federal unemployment, FICA, and Medicare that you're paying on your behalf, and never anything you're withholding out of an employee's check. That's what's going on out there, and that's what's there. I'm sure there's still some questions. So Jillian, I'm going to stop the share and turn on my chat, and let's take a look at some of the questions we have.
Thank you, Mitch. I do have a couple questions here, but as a reminder, you can click that Q&A icon at the bottom of your control panel to pose questions about what Mitch has just reviewed. I know there was a lot there. If you're watching us on Facebook Live, you can comment. We can get those questions posed to Mitch. So the first one I have, and I think you did kind of touch on this, but if you could just go back to it. The EIDL loan, is it true that owners are not eligible for bonus dividends for the length of the note if they've taken one?
Per the loan documents, they cannot make any distribution without the express written approval of the SBA. That's not to say they're not going to approve it, but you have to get their approval, and good luck getting them on the phone right now. The problem here, and it's the theory of the EIDL loan, is that it's different than the PPP loan. The PPP loan was to make your payroll, get you through all this. You have to have had some sort of business problems. The EIDL loan, you've said that your business has suffered irreparable harm, and without that EIDL loan, you're going to go out of business. Well, if you're going to go out of business, then why are you taking distribution and taking a dividend from your company while you still got this loan outstanding? So that is probably going to be the position they take. But if it's a situation, one thing that is there's a lot of confusion about that the IRS is auditing very heavily, and we make all of our clients aware of it when they come from their CPA. So if you have an S corporation, you have to take a reasonable salary if you're involved in that company. You can't just rely on what is called K1 income, on your pass-through income for your income. because if you do that, you're in essence avoiding paying Social Security on your own pay. And so the IRS is very, very careful about looking to make sure you're taking a reasonable salary out of your company. So if you're taking $70,000 or $80,000 out of your company, the SBA is probably going to say, that's it. If you're not taking any kind of salary out of your company and you're relying on that pass-through income, you've got another issue with the IRS that you're not taking a reasonable salary. And when you go to the SBA, they may drop a dime to the IRS and say, hey, this guy's not taking any salary. He's not paying into FICA. Go get him. And there's a task force that's looking at that up in Oklahoma City. So be very careful. But it's a problem that I tell a lot of my clients. You got to run your business like a business. You've got to make sure you're doing the right thing. You've got to make sure your tax pro understands what's going on, because a lot of guys that have been living off of their draws, off their K-1s for years, have not been taking reasonable salaries. They've not been paying into FICA, and the IRS is out to get them.
Thanks, Mitch. I've got another question here. Again, you can pitch your questions to Mitch by typing them into the Q&A box at the bottom of your control panel. Does the PPP amount received need to be deducted from our 2020 wages?
I'm not sure what they mean by that, but the PPP loan received is not going to be a taxable event. And when you pay the underlying expenses, say wages or salaries, so this is a sole proprietorship or a one-member LLC, when you make that payment, it is going to be deductible if you paid out to yourself a salary. But then again, on the other end of that, if it's an S corporation or if it's a sole proprietorship or an LLC with one member, the other side of that transaction is going to be you're going to be paying tax on your personal taxes. So it's really not going to be deductible. But I'm not sure exactly what the question is, but there's no tax event when it's forgiven, and the underlying items on the PPP loan that are paid are deductible. Now, remember, there's a $100,000 limit. So if you're paying yourself more than $100,000 a year, you're not going to be able to exclude, you're not going to be able to be forgiven for the amount over $100,000 you pay yourself or any individual employee.
Okay. We've got another question here. As it relates to payroll related expenses for PPP, are accounting software and third-party payroll service fees eligible?
They don't specifically say that the accounting software, I don't think, is going to be eligible for the cost of that. They don't really address third-party payroll fees, but I don't see where they would exclude them. But then again, you've got 26 weeks or 24 weeks to recoup the 2.5 months of payroll that you had. I did not have a single client that ran into an issue coming up against enough payroll and direct payroll expenses to get their entire loan forgiven. If you're having trouble over a 24-week period coming up with 2.5 months of payroll, then you probably have other issues.
What advice would you have for those company owners who got access to the EIDL loans and are now realizing, wow, what did I sign myself up for? What are their options at this point?
Pay it back. You can pay it back with a PPP, kind of pay it back with a PPP loan just by using it to make your payroll costs and your eligible costs. But if it's really restricting your business, if you have a really profitable business and you're not able to get money out of it, remember that is not what the EIDL loan was about. And you're going to have issues. They're going to make an example out of companies that took big EIDL loans and didn't need them and have used it. I had somebody that in one of our sessions had texted, well, can I use it to buy a boat? No, that's going to kind of stuff that'll make the 11 o'clock news. Can I use it to invest in the stock market? No, you have to be able to put this into your business, because you've said when you took out that loan that you've had a catastrophic event caused by COVID that your business will not survive if you didn't get that loan. If you keep on going just the way you've always been going and take $150,000 of distributions out of your business, it isn't going to look good. And every time you touch anything that has to do with the SBA or the federal government, just think of how that's going to look sitting across the table from an investigator from the SBA that's questioning why you, in their words, took advantage of the federal government. And it doesn't end well.
Thank you. If we deferred the employer portion of FICA, when would it be required to be paid back? You
have a year to pay back half of it. So to the end of 2021, and another year to pay back the other half of it at the end of 2022. And Again, the instructions on the 941 are now over 100 pages long. So make sure you understand what you're doing and how you're paying it back. But it'll all be due the first half of it on December 31st. So be ready for that check. But most companies are now running into some COVID related expenses. And of course, those are credits against that. So that'll reduce what you have to pay back. And the IRS has said originally when they passed this, they were going to give everybody a form to fill out to get the money in advance. Well, that never happened. But I know in our case, our particular case, we've had a couple employees that have been affected directly by COVID and one who had a kid out of school for 5 weeks. So we pretty much eaten up all of the deferred employer FICA and that we had. So we're not going to have any issues with having to pay it back at the end of the year.
If anyone has any additional questions, you can type them into the Q&A panel. You can comment on Facebook if you're watching us live there. I'll give you all just a moment longer, but it seems like we've gotten through a lot of these questions here.
Jillian, one thing to keep in mind is I got an email this morning from the AICPA, and even though the EIDL program is pretty much closed down for companies that are really, really suffering, I think this is aimed more towards restaurants, but of course that trickles down, and some of my fire alarm clients are suffering. They are probably going to have another round of grant type advances like the $10,000 in the EIDL, where you could apply for something like that. It's not going to be a lot of money, but it may be money that may make the difference in making a payroll or something like that. So watch out for that. If anything happens on there, we'll be sure to post it around the normal sources with ESA and with some of the other websites and the trade magazines, but be ready for that.
Any projected timeline on that, or?
They're working on it, and as anything with the government, it could happen tomorrow or it could happen 3.5 months from now.
Sure, absolutely. Well, I don't see any additional questions here from the group. So with that, one more. What is your perspective on alarm business valuations given COVID and the low interest rates?
Well, it's been really funny because I do a lot of valuations. I do about 25 a year, mainly for divorces and for partner disputes and for probate and for things like that. It depends on the segment of the business. What really got hit hard was the pure residential companies that did door-to-door marketing and did high pressure marketing. They really suffered because one, people were home all the time. They didn't need an alarm. Two, people didn't want to open their door to a stranger because they could get COVID. And three, they were home. They didn't want they didn't have a lot of money to spend on an alarm. They didn't want to get into a contract. So that suffered. But what's really hit that more than COVID is there have been some very high profile situations where portfolio, some of those companies that built their entire business on selling a lot of high pressure, low priced systems with very long contracts and very high RMR have had some failures, and the banks have suffered some losses. And it wasn't necessarily because it was a bad business model, but they overexpanded. They got into areas where they couldn't service the accounts. And what sets this industry apart from the cable industry, from the internet industry, is that customers in the security business have a very high expectation of service. And if you can't service those accounts, they're going to cancel. And so cancellation rates got very high. So really what happened was there were a few, Protect America is a good example, and there have been some others where they had a very large residential base that wasn't getting serviced like it should. And they went down, they took the banks a little bit along with them. Well, the banks looked at that portfolio, and two banks decided to pull out of the industry. That was Bank of America and Pacific Western, the capital source guys. They pulled out, which left a big hole in being able to borrow money. There's been a stampede of good borrowers from those two banks to the banks that are still in the industry, the Capital Ones and the CIBC and some of the other banks. But while that's been happening, there's been some slowing down and turmoil because the traditional buyers, the traditional deals couldn't get their loans funded, and they didn't have their facilities yet. So we've seen, just because there's a lack of capital and a lack of credit facilities available in the industry, there are less buyers out there right now. Whenever you have less buyers, you have lower prices. So we've seen in a lot of situations, some of the large scale buyers, their multiples have dropped way down. But on the other side of the coin, we participated in some transactions recently that had pre-pandemic type multiples, but there was something to it. It was a company with a very nice commercial base. It was a company with a very nice fire base. There was one company that we sold They just so happen that 10 miles of their AES network overlapped another company's 10 miles. And so by buying them, the other company extended their AES network out 100 miles. And so they paid a premium. So if you have a traditional company that's got strong earnings, that's got good service, the multiple should be fairly high. I think they got a little out of hand a couple of years ago. They should be fairly high. The residential side isn't necessarily tainted, but it does have a lot of issues with the conception of DIY coming in and taking away the business, with the conception of the large dealer program residential failing, with reluctance of banks to do some of these deals. But that'll start to settle out as the summer comes around and COVID goes away and things get better. I think you'll see some recovery in multiples, but the days of being able to sell a small company for north of 40 times, I think are pretty much gone. But I don't think that in the 30s to the multiple 30s is really an unrealistic multiple.
Okay, we've got another one here. Any thoughts on how the new administration will address taxes in the future?
Well, they've already said that one thing that they really want to clamp onto is capital gains rates. And as many of us know, no matter how happy you are with your business, you had an eye on selling, and we all know that capital gains rates have been at 0 to 20% for the last 10 years, and that's been a tremendous boon. But there are not a lot of voters that are going to sell their alarm companies in the next 5 or 6 years and are looking for a 20% capital gain rate. So if you're an administration that's looking for multiple things, one is new sources of revenue to replace the trillions of dollars that have gone out in COVID payments, and two, to favor your voting base, which doesn't have capital gains and doesn't own businesses and doesn't do these things, there's going to be a lot of pressure to push these capital gain rates back up to 37%. What that leaves out is family farms that have to sell off a part of the family farm because they're in the third generation. They're having trouble competing. They need to sell off some stuff. Businesses are selling where a guy with $30,000 of RMR would like to sell his company for $1 million and live on $40,000 a year the rest of his life. Things like that. Those guys are going to get clobbered because the perception in a lot of the population is that people that are living on capital gains are people that were born with, I guess what they say, born on third base and think they hit a triple, that they're making all their money from other people's money and bonds and trusts and family trusts. And that's out there, but that's really not why capital gains rates are lower. So that's going to be an issue. The other thing that's been very popular is the 21% corporate income tax. Now, hopefully none of you are C corporations unless you're a large company on this call. But when corporations aren't people, and that's a big misconception that a lot of voters have and a lot of people have, is corporations aren't people. And if a corporate tax rate goes up, they raise their prices. And if they can't raise their prices, when you're paying more money out in taxes, that's less money you have to spend on capital improvements. And we've had, in the last 3 years, since the corporate tax rate went down to 21%, a lot of large companies have had a lot of extra money left each year to spend on capital improvements. And when they build a new building, they put in a new alarm. When they refurbish something, they put in a new alarm. When they build a new warehouse, they put in cameras. That will probably slow some with a higher corporate tax rate. And so be ready for that. It's not a good thing for the economy. The last thing that's really big that the Biden administration has already said they're going to go after is the 20% deduction for pass-through income and Section 199A. And what that is, for people that aren't familiar with it, if you have an S corporation or an LLC that gets taxed as a partnership or an S corporation, the pass-through income, the flow-through income, like that question was asking before, is only taxed at 20%. They're seriously talking about either eliminating that altogether or lowering the maximums where you can take that deduction, which would probably affect a lot of my clients. And so you're going to see your income going down, the pass-through from your company going down, and there's really not a lot we can do about it. So I see that. I'm waiting to see how much actually goes through Congress. They're pulling back from the $15 a year minimum wage and saying, well, maybe by 2025, it'll be a $15 minimum wage. Doing it overnight could be devastating to the economy. And I'm not talking about just central stations and companies like that. If everybody's making $15 minimum wage and you have somewhat trained tradespeople making $16, $17, they're probably going to be asking for raises. And so you'll see the cost of wages go very, very much higher. And the only way the business is going to get it back is to raise their prices. Looks like maybe we have some more Q&A here, Jillian.
We do. You mentioned using payroll-related costs as a part of the PPP loan amount. Can you repeat what you said about being able to use health insurance costs?
Health insurance costs that you're paying on behalf of employees can be included in the amount that you're using to get the PPP, second round PPP loan. So if you have, let's say your health insurance costs are $10,000 a month, and it's all money that you're paying on behalf of your employees, that's another $25,000 in PPP-2 loan. Now, if you're deducting it from your employees' paychecks, no, you can't use that. And remember, the big overriding thing in the PPP program is these are items that you're paying on behalf of your employees, not things that you're paying that you're directly paying, not things you're withholding from their checks, like a 401k contribution that they're making or an HSA contribution that they're making or insurance you're taking out of their checks. It's things that you're paying on their behalf. And it's not any federal costs, but like I said, health insurance, if you're paying it on their behalf, 2.5 months of health insurance.
Okay, it looks like those are all the questions, Lee. Not a question, but a comment. I love the microphone and the audio clarity. Thank you, Lee.
Thank you, Lee. I appreciate that.
It looks like we've answered everyone's questions here.
Right.
I want to thank you for your time. Mitch, I know you're extremely busy, so I want to thank you for making the time as well, and thank Residio. And with that, we'll see you on the next ESA webinar.
Great, and looking forward to seeing you. And again, if you have any questions, you can email them to me. Send me an email, and I'll try to answer them. And if you're an ESA member, you'll never see a bill from us for a quick answer to a quick question. Thank you very much.
Thanks, everyone.